There's a real risk that when gold goes above 2,100, that it's really going to explode higher.
Hi, and welcome to the FinancialFox, Finance, Investment, and Crypto with a Twist. I'm your host, Steffi B. I'm the founder of corporate communication consultancy, Cassiopeia Services, and every week I bring to you my favorite conversation with investment experts, market disruptors, mover and shakers, and the coolest projects in crypto. So today I'm not talking about crypto, but I'm talking about gold, investing in gold that many investors are looking at as inflation is here to stay and there is a lot of tension with geopolitical uncertainty. My guest is Jordan Roy-Byrne, a gold proponent, a gold analyst, and the founder of TheDailyGold.com, a premium publication which emphasizes market timing as stock selection for precious metals investors. Now, before we go into the show, remember that any content here is for informational purposes only, so there is no financial advice and you need to do your own due diligence and research before making an investment decision. Now, if you're not subscribed to our YouTube channel and you are interested in investing, then you should click the subscribe button and follow us on social media to stay up to date with our news and interviews. I do talk about financial market, I talk about crypto project, and today we are going to talk about gold investing. Now, even though we are not going to talk about crypto, this episode is supported by CoinPass, the fast, secure, and compliant crypto trading platform for investors, traders, and businesses in the UK. So you can find more information in the description, and you can use the link also to open an account and start trading today. CoinPass brings the best of crypto to your doorstep. It's a fully regulated crypto platform offering a seamless and user-friendly purchasing experience. You can already find the top cryptocurrencies, and they are adding up to 4 new coins each month. They've just released their new website with improved UX and UI, as well as some powerful extra features such as DeFi option and staking that are coming very soon. And that is all in a fully FCA registered and compliant package to every CoinPass users in the UK. They've also introduced a brand new CoinPass mobile app where you can manage your portfolio on the go. And here is the coolest things. They have a very attractive referral program where you can earn up to 20% commission. So use the link in the description to open an account and start trading today. Hi, Jordan. How are you?
Hi, I'm well. Thanks for having me on. How are you?
I'm fine. So, it's great to have you on and talk about gold, investing in gold, which is a topic that is quite hot, has been hot when inflation started to rise, even more with the conflict between Russia and Ukraine. And many investors watching this show are asking themselves when gold is going to break, when we are going to see this super cycle that we are in that is going to send gold through the roof and silver through the sky. The $1 billion question for you.
Well, I think we're actually very close to that moment. And in past interviews over the last year or 2 or 3 years, I'd always say, oh, we're a year away, or we're 2 years away, we're 18 months away. And you never can project exactly because, a couple months ago, at the beginning of the year, I would have said, yeah, we're still probably, a year away, maybe 18 months, whatever. But obviously the war in Ukraine, it's kind of a black swan. It's definitely a game changer. The 1900 level in gold is very significant. And, I think in the lead up to the invasion, gold was trading in the mid 1800s. And then the very beginning of March, it made this, the day before it made this huge move, it looked like it had possibly put in a top because it made this big move and then it didn't hold, like the market gave back all the gains. But then the next day, gold had this very powerful move where it opened in the US at 1908. It exploded higher. And I mean, I know that it's come back, it's correcting some, and that's not a surprise. But I mean, it looks to me like around 1900, that looks to be a floor in the gold market right now. Most people look at daily and weekly charts. Few people look at weekly and monthly charts. But if you look at the monthly chart, for example, 1900 is a very key level. It's also a key level on the quarterly chart. And so we closed the month and the quarter last week. So the end of the quarter, I think we closed at 1940, 1950, something like that. So that's actually the highest gold has closed any quarter in history. So we call that a quarterly all-time high. And gold's monthly close was the third highest ever. So as a technician, because that's my skill set primarily, I mean, that's my expertise is, the setup of gold, technically, it's very, very bullish. And I think that gold, I mean, there's a real risk that when gold goes above 2,100, that it's really going to explode higher. And so I think that there's a real risk that we could see gold double in the next 2 years. So the setup, I mean, we are, it's rare for me to say this, but we are at a point in time where we literally are at a point where we're really close to where the market can take off. I mean, in the short term, gold it made that big move. It was up $300, I think, in 6 weeks, up to 2080 or 2070, wherever it was. So that sharp of a move, after you make that kind of a move in gold and especially commodity markets, you tend to see a consolidation. So gold is correcting, it's consolidating, it's digesting its move. And in addition to all this, the really important point is the stocks, the gold stocks, the miners, the smaller companies, they are outperforming gold during this correction, which rarely happens. Typically you have a correction in gold goes down 10, 15%. The stocks will go down 20, 30%. They'll go down more than gold. This correction in gold, that's not the case. I mean, we just saw GDX, for example, make a new 52-week high, a new closing high. So it made a new 52-week high last week. Gold isn't even close to doing that. And so the last time we saw this action where gold was correcting and the stocks were really outperforming, that was actually in 2009. In the middle of 2009, gold peaked in February around 1,000. Then it corrected, consolidated until I think the end of September. Then it broke above 1,000. So during that period, when gold corrected 15%. It was a bullish consolidation. So gold was correcting, consolidating. The stocks were actually trending higher and they made higher highs. And of course, after gold broke above 1,000, I mean, then at that point, gold almost doubled over the next 2 years. I mean, it got up to 1,900. And also, if you look at that, I think gold, from that breakout, I think it gained about 40% in a 6 or 7 month period. And it's interesting because, there's another similarity to where we are now. And so I'm looking at points where gold corrected and then it rallied back to the previous all-time high, and then it corrected again and consolidated. So 2009 was one time it did that. The other time was in 1978. And so after that happened and gold broke through again, it was up. I think gold gained like 42% in 5 months or so. Wow. So, I mean, I don't mean to like babble on and just belabor the point, but we are in a setup right now where there is a real risk. Like if you're not in the gold market, there is a real risk that you're going to miss like a potentially vertical move over the next, 18 to 24 months. And, I'm not saying like I'm always right or I have been right, but like I am always, in my past interviews, you can look, I'm always super cautious. I'm saying we need more time. Gold's not ready to really, fly to the moon. But this is one of those rare points where, at least in my view, and all the things I look at, I mean, gold is at a point where there's a real good probability that it can really go vertical here when it breaks above 2,100.
Okay, John. So investors, they are looking at the show and they wonder how they can get exposure to gold. Let's maybe list the opportunity and what they can do to make sure they have got something in gold.
Okay, well, so you have physical, which is if you buy physical or some form of physical, I look at that as a form of financial insurance. It's also, GLD, I think, is the most famous ETF. So, I mean, big money, like really big money, hedge funds, pensions, endowments, et cetera, they typically don't, or they rarely play in the mining stocks. They just focus on physical gold. So I think it really depends, what level of investor you are, and what your goal is. I mean, if you want safety or insurance, that's physical gold. Now, if you're obviously, most people, they're not managing a huge portfolio like a pension fund or a hedge fund. So those types of people, they can also invest in the stocks, but I like the smaller stocks. You refer to them as small caps. I mean, in North America, we call them juniors.
Okay.
So, I mean, I prefer the juniors just because it's a very risky business and they have a lot more, there's more risk in the juniors, but they have a lot more upside potential. So I tend to prefer those companies over individual big miners. I mean, it's very running the business of a big miner. It's very it's a very difficult business. They can have a lot of issues. And then I don't think they have the kind of upside potential that I really want to see. Like if you're in a real bull market in gold and silver and you're investing in the stocks, like you should be, to use a baseball analogy, you should be swinging for home runs and grand slams.
Okay. So let's say that gold goes up, I don't know, 10%. What will be the reflection on blue chips, right? So maybe a bigger gold miner and then a junior.
Well, I mean, it depends on the point in time. Not to step back from giving a direct answer, but generally you could say, I mean, if gold is up 10%, maybe the senior miners, the large companies, maybe they would go up 15 or 20%. And then, smaller ones could potentially rise, 25 or 30% or so. So
I thought you were going to say 100.
Well, I mean, I'm just talking, I'm talking about the average for everything. Yeah. So I'm trying to find the ones that go up 100% in that environment. So that's what I do. So those are the smaller stocks are very risky, but they really have huge potential. And so those are the companies that I like to follow and invest in. And I just prefer those types of companies. I'm more comfortable with those. But for the average person, it's very it's very difficult because there's huge risks. If you look at the charts of some of these stocks, you can see there's points where, wow, this went up, it went up 5x, or, it went up 10 times, but then it went down here, 50 or 60%. So I always tell people, I think we're at a point where we're over the next 2 or 3 years. There's a good chance we could see some huge gains in these small companies. But I always tell people there's huge risk. We have to, when these things go up, we have to trim, sell a little bit along the way. And we have to be very careful about how we manage our risk and manage these positions. I mean, this is not like a different industry where you can buy these and then in 5 or 7, hold on to them in 5 or 7 years, they're going to be, up a huge amount. This industry doesn't work like that. We're going to see a huge move. In my opinion, we're going to see a huge move in the next 2 or 3 years. But then after that, they could go down 50 or 60% again. That's just how it works. Okay.
So tell me a little bit about your secret to pick those junior that you think can actually outperform the market.
Okay, well, we have to separate. So you can have explorers, developers, and producers. So explorers, they have a project, they're drilling it, and they're trying to discover or basically prove up that this can be a deposit, that this can be a mine. So that's what exploration companies do. Development companies so they're further along the curve. Development companies, the asset has already been proven that it can become a mine. So they're trying to do all the final work before they start building it. So they permit it. They raise financing to build the mine. And then you have producers where they're actually producing. They tend to have smaller mines compared to the senior companies. So when you're looking at, so that's one way to look at it. I mean, my favorite aspect is probably the developers and producers, because you tend to get a huge re-rating when you go from being a developer to then a producer. And so in a bull market, how can you, like, if the gold price is going to go from 2,000 to 3,000 or 2,000 to 4,000, how can we leverage that gain? Well, we want to find small companies that are growing production the fastest. What are the companies that can go from 0 to 100,000, or 0 to 200, or they're going to go from 50,000 to 150,000 ounces, or they can go from 100,000 to 250,000. So those are the types of companies that I'm looking for. Production growth. And then you look at, there's many things you can look at. You can look at, what type of mine is it? Are the margins on the project good? So, I mean, is it going to be leveraged to the upside in gold? The people running it, have they built mines before? I mean, so that's a huge thing that I look at. So if someone has done it before, in their past, they built a mine, they sold their company. That's going to give you, as an investor, a lot more confidence in a risky situation. You want to go with someone like that versus someone who's never done it before. So with producers, those are the things I'm looking at. And then with smaller exploration companies, I try and find, management that have done it before. They've sold the company before, so they know what they're doing. I try and look for projects where I think that they have strong potential to become a mine. So that also means that the project has potential for a larger company to take them out and buy them out at some point. Okay. And so, there's many things to look at. I mean, it depends what kind of type of project it is. I avoid things that are really low grade and that are really small, basically, because the market really cares about size. Yeah. So you tend to want to look for something that's 2 or 3 or, up to 5 million ounces. The market in the industry prefers that type of size versus if something's only, it's only 1 million ounces. It doesn't, they're having trouble growing it. That's too small. Or if the grade is really low, and then also it has to be in a jurisdiction where there's big companies operating. So there could be, if someone has a really good, for example, let's say someone had a, really good find or discovery, and, let's say North Korea, very random, but let's say North Korea, for me, I would say, well, there's no big companies operating there. So no senior company is going to go to, North Korea and buy that. It would have to be the greatest thing ever, the greatest discovery in history for a big company to say, we need to go to North Korea. We need to, buy this deposit because it's so good. So I tend to stick to companies that are already set up in that country or that area. And I mean, there's major companies all over the world. I mean, they're in Africa, they're in, North America, they're in South America, Central America. So that's another important factor, because if you're looking at an exploration company and you say, oh, well, this is pretty good, this can become a mine. If it's big enough and it's close to where a big company is operating, the big company will probably buy them out at some point. So I try to look for, it's really risky, but there's all these factors that you look at to try and eliminate, stocks that have, they don't fit the criteria. And another thing with exploration, if the stock has already gone up a lot, let's say that stock has gone from, 20 cents to $2 or $3 already. You don't see that many $2 or $3 stocks in this industry becoming $10 stocks. Like it's really rare. Now, it might happen a lot in the next 2 or 3 years, but it's really rare. So that's another thing. Like if someone asks me about a company and it's already made a big move, it's like, okay, I'm not that interested. So
what kind of big move you look like 50% up, just to give some kind of direction?
Well, it depends. If it's, 50% is 50% is not a deal breaker for me. If it's something that has already gone up a big amount and the chart looks like this, the chart looks like that, where it's going straight up, basically. That's something that I would avoid. Now, if it's gone sideways for a while after it went straight up, then you might have a better entry point. So there's all these different factors that you have to know and look at. And I've been doing this for 20 years, and I know way more, obviously, than I did 15 plus years ago. But when the market is really good, anything can move and go up a lot. And so you have to be really careful to not think that you're an expert and everything. There's bad companies that can go up 5x or 10x in a really raging bull market environment. So it's and then you just have to use common sense. Like I like to, if something's not performing well and it's a loser, I tend to sell those. When we get those huge moves up, you have to sell, 30%, 50%, 25%, pick a number along the way, because that's a prudent way to, invest and trade these types of companies. You're not buying Coca-Cola or Walmart or whoever. Like these companies are not going to be around in 10 or 20 years. So you have to understand that and act accordingly.
The question that investors will say is when obviously should I sell? When should I buy? We kind of explain when, it's not gone up, it's kind of going sideways and there is the opportunity, to go higher. And then when it goes up, it's like, how do you judge? Because it's not easy to judge when it's time to sell. It might goes up a lot, but the management team is so clever that it start to put out more news flow to keep you on the hook. And then you think, oh, that's that. So I should wait. And then it start to drift down and then you don't want to sell because you don't want to admit that you should have sold before.
Well, it really depends on many factors, but for the type of company, like when you're investing in tiny exploration companies, sometimes they can make a huge move, but the news or fundamentals don't really support that move. Yeah. So when that happens, you would probably, those types of companies, like in that type of situation, I would probably sell half. Yeah. Now, if it's a developer or a producer, and because I have an ultimate, when I look at these companies, I have an ultimate projection of how much is this thing worth at 3,000 gold, and I factor in inflation along the way too, with cost inflation. So if gold's going from 2,000 to 3,000, their cost of mining is probably going to go up along the way. So I factor that in. But back to your question. It also depends on the ultimate value. What do I think this thing could be worth at 2,500 gold or 3,000 gold? How close are we to that point? It's things like that, and also looking at the market. Like I think that over the next year to 2 years, we're in a situation where we could see some huge moves. So I don't want to sell anything too soon. Yeah, exactly. And that kind of, so it's like, you don't want to sell anything too soon, but at the same time, you want to take some profits along the way. And that's why normally I say sell 1/3. If it's a really risky stock, sell 1/2. Maybe you only sell 1/4 of it. You sell a little bit of it, and then maybe if it keeps going up in 3 or 6 months, then you sell a little bit more. And so you take that money and you redeploy it in things that probably have less risk and better value at that point. But in so doing that, at the same time, you're still holding enough of the original position where if it keeps going to the moon, you're still going to make money on it. And, if it turns over and it goes back down, great. You trimmed it. You were able to sell some of that. So because we can't, every investor thinks they're going to, be able to buy at the bottom and sell at the top. It's impossible to do that. So that's why you have to have some kind of a plan to follow. Otherwise, you get really emotional and you'll make the wrong decisions.
Okay, I think that was a great insight. I don't want to say advice, but a really great insight to people. So now, where should investor look? Should they look more like US listed company or Canadian, or do you think it doesn't really matter? It could be good to invest in some Australian listed company or London listed company. Is there any kind of criteria that you use for that?
I mean, I tend to prefer Canadian listed companies, but
okay.
it's okay. Yeah, I do. I am a little, if it's only listed in the US and it's a smaller company and it's not in, Canada or elsewhere, Canada, Australia, London, that to me is kind of a red flag. So okay. I do prefer, like, if you're only going to get one listing and you're a small company, I would prefer it's those other three places. But overall, it doesn't really matter to me that much. But I mean, you have to, you have to have a broker that can buy direct from these exchanges. I mean, a lot of these companies, they trade over the counter in the US. And I mean, that's fine. I don't have any issue with that. But I mean, if, for example, for the European audience, I would say you probably want to have the ability to buy in Canada, because Canada is really the biggest resource market. I'd say Canada first, then maybe US, Australia, then London after that. So if you're a European investor, you really do need to be able to buy from Canada.
Okay, I think that was it was important to say, because lots of investor perhaps in the UK, they might just be looking at UK small miners when they might be losing up on the big gains that the junior are doing in Canada. So you would say Canada is basically the place to watch. Then you can go to US, Australia, and then eventually look at the London market. I mean, some miners on the LSE, they are also listed in Canada. So that is kind of
right, yeah,
a reason. Okay, now, shall we leave the last comment about silver? Because we talk extensively about gold, and I know you are a big gold proponent, but silver is just behind and it can actually catch up or even, move higher. What do you think is going to be ahead of silver?
I think that silver, it's something I've been researching. I mean, right now, I think the silver does better than gold when you have like a growth plus inflation environment. Yeah. And right now we're basically in a stagflationary environment where you have really low growth and high inflation. So that tends to favor gold more than silver. But that being said, I do think silver has underperformed a little bit. It has really stiff resistance around 27 to 28. But I do think that when gold breaks above 2,100, that we should see silver start to outperform gold. So after that happens, I think silver will outperform gold. And I tend to think that, the magic number for silver is 50. 50 was the peak in 1980. It was the peak in 2011. Silver has, again, stiff resistance, 27, 28. There's a little resistance in the mid 30s, but once silver gets above 30, I think it should be able to get to 50, especially because assuming that happens when gold is already above 2,100 and has momentum. So the measured upside target for gold from this breakout is around 3,000. And so I tend to think when gold gets to 3,000, silver can go to $50. So, long story short, yes, I'm a huge fan of silver, but it's more volatile than gold. It's more inconsistent. And with that being said, I do think when gold is able to break above 2,100, at that point, I think you'll start to see silver outperform gold. And to go back to what I said before, the gold stocks are outperforming gold now. It's similar with silver, actually. Silver is fairly weak. I mean, I saw it came down to $24 US today. Silver's been kind of weak, in my opinion. And the silver stocks are outperforming. They're doing really well. So that's another good sign, because if silver is down 10%, I mean, the silver stocks, they might be down 30, 40%. So the silver stocks are holding up really well. Silver kind of disappointing here in the short term. But again, if we see gold break above 2,100, and it's going to have some real momentum at that point. And to me, that's when you're going to see more capital flow into silver. So that's one reason I like silver, because predictably, when we see gold start to move up and it looks like it's going to make a bull move, silver hasn't really moved yet. And so then you can look at, I can look at silver and silver stocks because they haven't really moved yet. But I'm confident, knowing that gold will keep going, that eventually silver and silver stocks will move with it.
Okay, Jordan, thank you so much for sharing all of these tips, strategy. Now, for any investor that is interested in reading your publication, because you have got two premium publications in the US where they've got lots of information about small cap miners and gold investing. So how should they get this content, and how can get in touch with you as well?
They can follow all my work at my website, TheDailyGold.com. I post articles, videos, interviews. There's a link to, I have an old book. There's a link on my website, so you can get a copy of a PDF copy emailed to you. I'm going to be updating that this year and doing videos around the book. I'll be putting out all my research that way. So go to my website, opt in there, get on my email list, and then you can get all my free content. And, hopefully you'll start to learn a thing or two about investing in this sector.
Okay, Jordan, thank you so much for coming on the show. And I hope to have you back soon when gold make the big moves.
My pleasure. Thank you so much for having me.